Hello, community. Hello, YouTube. It is Gustavo once again with another video. But today's video, guys, is going to be a bit different because we are literally going to talk about liquidity. Our topic today is just liquidity. And the reason I'm doing this video is to show you guys that the market is evolving. So as the trader needs to evolve. The game is evolving so as the trader who's playing the game should evolve. The market is no longer the same as when Warren Buffett was trading, when Mark Douglas was trading. It's evolving, and it's not going to be the same in the next decade from now. So people need to understand that when the market evolves, you as a trader, you need to evolve. You as a retail trader, you need to evolve. So not going to talk about anything else but liquidity, and not going to talk much about anything else but liquidity because I feel like it's the most significant thing right now. And I've been getting comments from YouTube. I've been getting people approaching me. I've been getting people texting me, emailing me, saying that I should drop this video so they can understand what is liquidity and how to spot liquidity and how to capitalize on the opportunities. So in today's video, it's literally about liquidity, as I've said, and we're just gonna scale down into smaller time frames. We're just gonna make examples on how to enter, where your stop loss should be, what percentage you should be risking, whether you are funded or you're just doing a personal account. So before we start into anything, right, the first thing we need to understand is market structure. So if we go on a daily time frame, right, let's say this is a daily time frame, right? This is your daily time frame. This is the biggest time frame. And the market is going down, right? We're just having a descending channel, descending channel, descending channel, descending channel, descending channel. And then it pulls back up. In this daily structure, it's clear that the market is going down. So what you need to realize that when the market is going down, we are only looking for supply areas only. When it's going up, we're looking for demand because we're demanding it to go up. We're supplying it to go down. So when your market structure says we are bearish, we are looking for supplies. When your market structure says we are bullish, we are looking for demands. So in this moment, as you can see that the structured market is down. So on a daily time frame, our structure is already telling us that we are looking for sales. When we scale down to a low time frame, let's say 4 hour time frame, right? This is the 4 hour time frame. And the 4 hour time frame is the same thing, right? We're going down, but now it's just zoomed more into the picture, right? Zoomed more into the picture. So now on our day time frame, we know that we are selling, right? We're looking for sales. On our 4 hour time frame, we're still looking for sales because we're following the high time frame. But now on our 4 hour time frame, we're looking for our liquidity points. We're looking for our point of interest. We're looking for our fair value gaps, you name them. But the most significant one is that we are looking for liquidity. So as you can see that we had a lower low and we had a lower high. We had a lower low and we have a lower high. Now we have a lower low. So what are we expecting next? Of course, we're expecting a lower high, but how do you capitalize on that lower high? The moment the market structure breaks this level here on the lower low, the moment it breaks, right, that is what we call a BOS. And be in mind, guys, this is no ICT SMC strategy. This is just experience. The moment the market structure breaks that lower low, we already looking for the lower high, right? We are looking to take entries on the lower high because why? The market structure broke. A lot of people would look for break and retest, but we understand that liquidity is always on the lower high if the market is bearish. And if the market is bullish, it's always on the lower low, right? So right now we are looking for entries on the lower high because that's where liquidity is. And you're asking yourself, why is liquidity there? Because a lot of traders, especially retail traders, are waiting to dump the market at the lower high. A lot of traders have their sell stops, sell limits. Some of them already have market executions before the market is even there to dump the market. So what's going to happen is the market is going to go up, right? Tap into that area, right? It broke here. So this is a BOS, meaning it's a break of structure. It broke the structure. Now we're waiting for liquidity here, right? We're waiting for the market to come back here so it can drop. But the market doesn't usually do that most of the time. So what do we do when it comes to this situation? So since the market broke here, this break of structure right here, and it broke back in, and we're looking for this lower high to take our trade in this liquidity. So on the 4 hour, we're just waiting for reaction on that lower high. So if the market is here and there's like 4 candles left for you to take the trade, so it can get into the market structure, so you can take the trade, you wait. The whole point of this is to wait. You wait for liquidity, you wait for the market to do what it needs to do. And if it does not do what it needs to do, it doesn't mean that next time you should change your strategy. It's all about probability, guys. So you wait for the market structure to do what it has to do. The moment it comes to the lower high, right? The moment it comes to this lower high, you're already looking for sales. We have our confirmation from the lower time frame that we are looking for sales because we know when we're selling, we are looking for supply areas. And another thing, when the market approaches the lower high on the 4 hour time frame, so daily, remember, we're looking for structure. Where's the market going? Is it bullish? Is it bearish? On the 4 hour time frame, we are looking for our points of interest. We are looking for our liquidity, right? But mostly on the 4 hour time frame, it's all about patience. You wait for the market to get into that area or to tap into that zone so you can sell, no buy. So in this area, in this moment, we are waiting for market confirmation. What do I mean? We're waiting for the market to get into that area and react, give us some type of clue or confirmation that right now we are going to sell because of X, Y, Z. Majority of the time is liquidity. And I'm going to scale down to a low time frame to show you what liquidity does and how you can capitalize it. But I want you to be sure and I want you to remember this because it's so significant that on the 4 hour time frame, you're just looking for reactions. Guys, as a trader, you don't need to rush. Your job is not to trade, is not to direct where the market is going to go because you don't have the power. Your job is to react. The moment you realize that your job is to react when the market comes into a certain point or key level that you expect it to come and reacts the way you want it to react, that builds confidence because confidence builds confluence and vice versa. That's when you can take the trade. So daily, I want you to remember this very clearly because it's so significant. Daily structure, buying or selling. Are we bullish, bearish? 4 hour time frame is reaction. What does the market react? How does it react when it comes to a certain key level or supply or demand, whatever it is? So in the 4 hour time frame, right? If the market is going up, what are we looking for? So we were waiting for this pullback for maybe 8 hours, two candlesticks, for example. That is the whole point of patience. Patience is not only waiting, but what you do while you wait. So in the 4 hour time frame, we are waiting for the market to pull back into this area, right? Now we're dwelling down into our 1 hour time frame. On a 1 hour time frame, it's much more scalable, right? So the market is going down, same structure. We had our break of structure right here. We had our break of structure right here. Sorry for my drawing. We have our break of structure right here, right? So the market broke the structure. Now we're looking for liquidity here, right? We're looking for sales there. Since the market is selling, we are looking for supply areas. So this was our 4 hour reaction. This is the 4 hour. 4 hours is all about patience. When we got into a 4 hour, now what the market does, when the market gets here, the big players, the people who have a lot of money, we know that we call them market makers. We have a lot of terms for them. We call them banks. What they do, they understand that a lot of retail traders have their sell limits, sell stops, whatever they have, but majority of traders are waiting to dump the market, are waiting to sell the market. So what do they do? What do? They buy the market. Institutions, market makers, they buy the market. Why are they buying the market when the market is in a sell zone? They buy the market because they understand that a lot of retail traders are there. They want to buy the market, but buy it short for a short period of time. That short period of time is called market manipulation. That short period of time is called break back in, retest, right? That short period of time is called sell stop. That short period of time, call it what you want. But that short period of time is that the funds of the big guys who actually have control into the market are putting a lot of funds that they're buying so the market can cross above and take everyone's stop loss, especially retail traders. Stop hands, it takes you out immediately. When you hit your stop loss there, it takes you out because it knows that a lot of retail traders have their stop losses above that lower high, above that supply area. So it takes them out. That's why a lot of retail traders, I call them headless chicken traders because they do what they have to do. They don't have a plan. They don't know why it's happening. It's just trade for the sake of trading. It takes them out, right? It takes out your stop loss. Now you're out of the game immediately, right? And then what does it do? It dumps again. But now bear in mind that the same amount that it's dumping the market. It's not the amount that it bought the market. Because when it bought the market, bought it with its own capital. So it can take retail traders out. Now it's using the retail traders' capital to dump the market. That's when the big boys come. That's when you come in because you understand liquidity. So this is the 1 hour time frame. That is how it's going to be. It takes people out, takes out liquidity sweep, takes out your stop loss, takes out your stop hand, takes whatever you had above, but you're out of the game at this point. Then it drops, right? This is what the market does. This is what liquidity does. But how do you capitalize this? Scale down again to a 15 minutes time frame. This applies for day traders. This applies for scalpers. And this also applies for swing traders because the market is so vast and it's so broad that the only difference from a scalper, a day trader, and a swing trader or opposition trader is just the patience. That is the only difference. But the market structure is the same. But the patience is the difference. The difference, right? So this applies to anyone who's trading different time frames, different Asian sessions, different London sessions, different whatever. It applies to everyone who is trading. Applies to stocks, Forex, indices, commodities, equities, and futures. So scale down to a lower time frame at this point, right? Get down to a 50 minutes time frame. Same thing, break of structure, came back, got liquidity here, right? Remember, this pullback is the 4 hour. Patience is the 4 hour reacting decision. We don't do nothing, waiting for the market to come back here. On a 1 hour, we're waiting for what? For market manipulation. On 1 hour time frame, we're waiting for the market to break above and come back in. But how do we know it's going to do that? By giving us candlestick confirmation. So if it's giving us a rejection in this area, if a lot of candlesticks, no one gives us a rejection in that lower high area, telling us that it's already took out the stop losses and now we are about to dump the market. We are about to go bearish. But now, if you want more confirmation and more clarity, there's two types of risk. There's the risk that you take when the market gives you confluence on the rejection immediately and closes and goes to the next bar and you take the trade with the sell, or you wait for the second bar to give you momentum to show you that, okay, we took our traders and now we are selling. Why are we selling? Because there's momentum. Sellers are in the game right now. There's momentum. So you have two confluences when it comes to candlestick. So there's two types of entries. There's the normal entry where proper risk is managed, and there's a risk entry where the risk entry, you don't wait for the second candlestick to give you confirmation that we're about to sell. You just take immediately when the first candlestick takes people out, stop hand, it takes your stop loss above and it's about to drop. Immediately when it closes with a rejection, you literally take the trade with the sell. So there's two type of entries. And I'm going to dwell that into the next video that we're going to do. So right now, on a 15 minutes time frame, you are looking for entries. How do we enter? On a 1 hour time frame, it's really clear that we got our rejection candlestick, right? It took trade is out and then it's about to dump. So in our 15 minutes time frame, we go scale down to a 15 minutes time frame. And what I like to do on a 15 minutes time frame is to, after I got that rejection, after I got that liquidity sweep, after it took out retail traders with their stop losses, stop hands, buy limits, sell stops, whatever it is that they had above the lower high, and we took them out. And how do I enter? So majority of the time I like to play it safe because I feel like the more you play it safe, the more you learn the skill and you enhance it and you become better in it. I'm not saying I don't take risk trades. I do, but for you out there who's starting and want to understand liquidity more, it's the proper way is to wait for clear confirmation, right? And after this scenario, I'm going to show you what type of confirmations you need. So in the 15 minutes time frame, what do? You take the entry. How do you take the entry though? Right? Okay. What did the market give you? Right? The market dropped. We were going bearish, right? Broke break of structure right here. Break of structure right here, right? Pull back right here. The pullback phase is a reaction phase. We're waiting for the market to get to that level and see how it reacts. How did the market react? On a 1 hour time frame, well, the market created a rejection. It took traders out. It took their stop losses out, right? It took everything out and then dropped. So the market makers took their stop losses and it dropped. But how do I capitalize on that? So the moment it creates rejection in this area, the moment it gives you confirmation that we took traders out, right? The confirmation is candlestick. The confirmation is candlesticks. Candlesticks are going to tell you. Candlesticks are going to tell you that we took traders out. There's liquidity sweep. Liquidity was performed and was well executed. Now I'm going to sell because that's when a lot of traders who know liquidity are selling right now. Traders who don't know liquidity, who don't know how to trade liquidity, or don't know the market so well, their stop losses have been hunted a very long time. And you, as a retail trader who understands liquidity, now you enter on the 15 minutes time frame. On the 15 minutes time frame, there's no other confirmation. On the 15 minutes time frame, the moment it gives me that, I take the trade. But also remember, guys, with this strategy, not even a strategy, but this concept, it's that you need to be aware of risk management because a lot of people been taking liquidity trades and not being bare in mind or aware of liquidity and risk management. So the whole point of this is you to be more risk management. It's pointless of me showing you this if you don't have your risk together because it's not about making it, it's about keeping it. So as much as this is the blueprint and the most simplest thing you can ever do. I've done this for more than 100 trades and I am profitable till this day because I don't keep the market complicated. It's only simplicity. Simplicity beats anything. So on the 15 minutes time frame, you take the entry. You literally take the entry. Your stop loss is above. If you're risking 1% of whatever account you have, then let it be. But make sure that your stop loss is above that area, is above there. It is above that lower high. It is above that higher low if you're bullish. It is above that lower high if you're bearish. Just make sure that you don't enter the trade without a stop loss. That is risk management. And another thing, guys, is make sure that when you trade, master discipline when it comes to your trades. Do not trade things that you're uncomfortable with. Do not trade things that you don't have data about. Don't go and trade NASDAQ if you haven't traded NASDAQ or backtested NASDAQ ever. So trade currencies that you're comfortable, that you know, and that you fully understand. And another thing is this game requires patience. Be patient. Be patient. It's not your job to trade, it's your job to react. Your job is not to trade, you react. So let me wipe this off and just make it pure clearly, right? Because We just talked about liquidity, how to take liquidity, and how to capitalize on the trades that have liquidity, right? So back again, on the 1 hour time frame, we have the 1 hour time frame, right? We have the 4 hour time frame, right? We have the daily time frame, right? And we have the 15 minutes time frame. Each and every time frame here, these 4 time frames have their own purpose, literally have their own purpose. On a daily time frame, we know that we're looking for market structure, right? We're looking for market structure. That is daily time frame. We're looking for that the market is bullish or it's bearish, right? It's either we're bullish or bearish. The daily time frame is going to give you confirmation. The daily time frame should be the one that's going to tell you we're bullish or bearish, because the daily time frame, the higher time frame, is always the one. Always listen to the higher time frame. Always don't go against the high time frame. If the high time frame says we're bearish, and in when you scale down to a low time frames, you're looking for sales. You're looking for anything that's going to say sell. That's when you build confidence. You're looking for anything that's going to say sell. So if, for example, I'm on gold and gold is bullish right now on a daily time frame, it's going up. I'm going to scale down to my 4 hour time frame. What am I looking for in my 4 hour time frame? I'm looking for key levels, right? A lot of them can call them key levels. People can call them whatever. I'm looking for key levels. I'm looking for demand areas. I'm looking for supply areas. I'm looking for liquidity. I'm looking for liquidity. Where is the liquidity? Where is the liquidity? Right? Where is the liquidity? When I go to my 1 hour time frame, I am looking for behavior. Looking for behavior. On my 15 minutes time frame, that's my entry. I'm taking the trade on my 15 minutes time. This is when I take the trade. I'm looking for my entry. Entries. I'm looking for my entries, right? So, to make it clear and concise, daily time frame, market structure, bullish or bearish. On a 4 hour time frame, we're looking for our key levels, we're looking for our demand, we're looking whatever it is, but we're looking for an area where the market is going to be or where it's currently at, right? So the whole point of the 4 hour time frame, if the market is not where you want it to be in a certain key level or a certain area where you think it's going to take liquidity, the whole point of the 4 hour time frame is patience. Wait for the market to get there. If it's already there, then that's a good thing. If you marked a key level or an area and the market is already there, then that's a wonderful thing. What do you do now? You scale down to your 1 hour time frame. Okay, what am I looking for in the 1 hour time frame? Well, I'm looking for behavior. How is it behaving in that key level? Is it respecting the key level? Has it respected the key level previously? What is it doing right now? Is it giving me confirmation that I'm selling? It should give me confirmation that, oh, it's a false breakout. It's about to buy. Sellers are more than buyers. Buyers are more than sellers. What reaction, what behavior is it showing so I can have my confluence and I can confident to take the trade? And on our 15 minutes time frame, it's simple. You just take the trade. The reason we scaled down to our 15 minutes time frame is to make it a much broader thing. So you can see it clearly that, okay, on my 1 hour time frame, it was behavior. On my 15 minutes time frame, I'm taking the trade, right? My 15 minutes time frame is my execution trade. It's my entry trades. I am taking the trade on my 15 minutes. So that is the simplicity of it. And bear in mind, if you just trade only liquidity, you trade liquidity by understanding these 4 concepts: structure, patience, behavior, and entry. Structure, right? Structure, daily time frame, reaction, 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 1 hour time frame, behavior. Reaction, behavior is the same thing. 4 hour time frame is the patience, it's the key points, it's the liquidity. Where's the liquidity at? It's the demand areas, the supply areas, the key levels, the key areas, the point of interest. It's your fair value gap. It's your OP, whatever it is, whatever key level you have there, whatever key level you have there, is it significant enough? Is it significant enough for the trade to buy or to trade to sell? On our 50 minute time frame is the entry. So that is my model. That is the simplicity of it. And guys, pick your pairs. Pick your pairs. Just pick your pairs. Pick the pairs that you're comfortable with. Pick the pairs that you have data on. Don't trade everything. The max pairs I think you should have is five. And also, I think you should have one commodity day. Gold. I think you should have gold. I feel like even each and every trader should bring gold. Gold is volatile, yes, but you only trade gold when you understand the risk that is involved with gold. But the other four is just any pace, but also major pace. Because my pace is just this, it's five. It's gold. In each and every these pairs, there's USD. There's USD inside. Why is the USD? Because I know that if I'm buying USD, I'm selling the other, right? If I'm selling USD, I'm buying the other. It's correlation pairs, right? So if I have five trades, I have five pairs. I know that, okay, it's Euro USD, GBP USD, USD JPY, AD USD, and gold. Gold, XAU USD, gold. So all of these pairs have gold. So I know that when I'm selling here, of course, they're selling. If I'm selling here, I'm buying the other one. If I'm buying the other one, I'm selling here. So just pick pairs that you have experience on and that you have data on. And to wrap this up, people, this is the most simplest format that a trader can learn on how to take their trades and how to understand liquidity. I mean, if you look at people like the Greek, if you look at people like inter-equities, if you look at people who actually understand liquidity, if you look at people who trade liquidity, they're going to tell you the same thing, right? They're going to tell you the same thing. The out of all of this lesson, what I can say to the most significant thing when it comes to liquidity is patience. Wait for it to take the traders out. Wait for it to create the market sweep. If it does not create the market sweep and it still goes a direction, it's okay. And if you said that you didn't take the trade because it didn't create the market liquidity, it's okay. But I promise you, in 100 trades, 99% is going to take liquidity because that's how the market structure is built. That's how it is, right? That's how it is. So bear in mind that even if it doesn't take liquidity but goes to your direction, don't feel sorry for yourself. Don't feel ashamed. Don't feel like you need to change something to your strategy, change something to your investment. Don't change anything. It's just probability. It's a probability game. So you need to understand what you want, what you're looking for, and how's it executed. So that is it, guys. I'm gonna drop another video if I can get this video to 100 views. But I'm going to drop another video. Definitely, I'm going to drop another video. And I am so happy that I've shared this with you people, with my community, with my traders on YouTube to show them and show everyone else. Because as I've been shown, that it's literally simple. If you keep things simple, things are going to be simple for you. Don't get things complicated. Don't make anything complicated. Don't make anything complicated. The market structure is evolving. Evolve, keep things simple as they are. Simplicity beats everything. And always apply proper risk management. And you only lose when you give up. You only lose when you give up. So for people out there who are still trading and haven't seen results and been trading for a very long time, but are not where they want to be, you only give up when you quit. And it's vice versa. You only quit when you give up. You only lose when you give up. So the moment the fact that you still have an account, you still funded, you still have that $10 there is something that you're winning. It's not this. Sometimes you might lose the capital, but you're gonna gain the experience. You're gonna gain the lesson behind it. Why, why did I lose? So it doesn't matter how much you have in your account, what eight-figure or $10 you're trading. The whole point of this is do not give up because you only lose when you give up. So from me to people, it is Gustavo. See you on the next video.